Well, welcome again to the special presentation of the Richardson Chamber of Commerce. I'm Paul Bindle, Senior Vice President of the Chamber and your MC today. Since the beginning of the COVID-19 crisis here in North Texas, the Richardson Chamber has been offering informative and educational programs that provide information to our member businesses and the business community in general to help business owners and managers deal with the various challenges this crisis is having on our communities. And today we have another outstanding COVID-19 program series presentation by two of the top tax attorneys with the Dallas office of Thompson Knight. Now, before we introduce them, I want to address real quickly again, for those of you that may not be familiar with a WebEx platform, how we are going to answer questions for you at the conclusion of the presentation. Use the Q&A platform. There's an icon at the bottom of your screen in that row of icons, or you can raise your hand in the process as well. We'll recognize that hand raising. We'll also repeat the question for you at the end of the presentation. So we are ready to get going on that. So let's move on with our program. The reopening of the Texas economy has had mixed feelings. We all know what those are. We've seen the well-documented media reports, government-issued statements, and news conferences and other sources. And as it has done with SBA loans and payroll protection programs, the federal government has taken several steps to help businesses through this uncharted territory. From tax breaks intended to provide businesses with liquidity, to deferred filing deadlines and modified enforcement efforts, the Internal Revenue Service has been ready to help. But are you and your business aware of these changes and are ready to take advantage of the tax benefits that may be available to your company? Today, we're going to try to answer those questions. Abbey Garber focuses his practice on tax litigation and providing advice in connection with applying tax laws to individuals, estates, corporations, and partnerships. Serving more than 30 years in the Office of Chief Counsel at the Internal Revenue Service, he tried cases of all sizes in tax court, earning significant favorable opinions in fraud, tax shelter, and many other cases. Abbey served as the Southwest Area Team Leader and Chief Counsel and was charged with ensuring collaboration and cooperation across operating divisions in a 9-state area. Joining him today is Meyercord, who focuses her practice on federal, state, and local taxation of corporations, partners, individuals, and nonprofit organizations. She provides clients with tax planning advice on mergers and acquisitions, the operation and disposition of partnerships and limited liability companies, along with private equity transactions. She represents taxpayers in IRS audits, appeals, and federal income tax litigation. She counsels clients on organization, operation, and termination of nonprofit corporations and trusts, and obtaining and maintaining exemptions from these organizations from federal income, state franchise, sales and use, and local ad valorem taxes. Lee is a board-certified attorney in tax law with the Texas Board of Legal Specializations. Please welcome Abbey Garber and Meyercord of Thompson Knight. And Abbey, you're going to start the presentation, so I'll turn it over to you. Welcome.
Okay, wonderful. Thanks, Paul. Paul, can you wave at me and tell me that you can hear me okay? Good deal. So I am Abbey Garber, and Lee, can we see you?
Yep. I hope so.
Okay. Thanks for being here, everybody. We were talking the other day, and we said we really did not brand this right. We should have titled this "Free Money for You," and that would have spurred attendance. But now we know the people that are here for the right reasons, and that's that it's 90 degrees outside, and daytime TV is just not that exciting in June. So here's what we look like, since you might not intuitively match our names to our faces. Both of us are native Dallasites. I was a lawyer and executive, as Paul mentioned, with the IRS until joining Thompson Knight 2 years ago.
Yeah, and I'm a TK lifer. I clerked for the firm when I was in law school, and then I've been with the firm since I started practicing in 2011.
And since I know we have some Richardson luminaries in the audience, I want to mention my RISD roots. I'm a proud graduate of Lake Highlands High School, which may not be in Richardson, but it is in the Richardson Independent School District. So
I don't have any Richardson credentials, but I do live near Richardson. And pre-pandemic, I felt like I drove my kids to a birthday party in Richardson every other weekend.
all right, well, we'll give you a couple points for that, Lee. All right, so we're going to cover what you see here: business favorable tax provisions in the CARES Act, the Paycheck Protection Program, which has gotten tons of media coverage, payroll tax credits and payment deferral, which were also part of the CARES Act and can really help your business. And we want to tell you a little bit about where the IRS stands now and where we think they're going to be doing when they get back up and running completely. But we do want to talk about whatever is important to you. So ask questions about our topics or anything else, and we'll try to respond. As Paul mentioned, you can type in questions in the chat box anytime, and we'll also try to open up microphones at the end. So ask away.
All right, so I'm gonna kick it off on the CARES Act, which is the section that's going to talk about free money that was really your money to begin with, and it's how to pay less in taxes or get a refund under the CARES Act. So the CARES Act is the Coronavirus Aid, Relief, and Economic Security Act, and it was signed into law on March 27, 2020. It's a $2 trillion stimulus package to mitigate the economic devastation from the coronavirus, and includes a number of tax changes to increase liquidity by allowing companies to either pay less in taxes this year or get a refund for prior taxes. Those changes include changes to the NOLs, the use of NOLs, changes to the interest expense deduction limitations, changes in the ability to monetize AMT credits, changes to the excess business loss limitations, and changes to the bonus depreciation rules. So we're going to start with the NOLs. So if you go to the next slide for me, Abbey, we're going to talk about the Tax Cuts and Jobs Act of 2017 first. So this is what we'll refer to a number of times to kind of explain what the law was and how it's changed. So I'll call it the TCJA. And the TCJA eliminated the ability to carry back net operating losses. It limited NOLs to 80% of taxable income in any one tax period. So if you had $100 of taxable income, you could only offset $80 of that taxable income with NOLs. And it lifted the previous 20-year limit on NOL carry forwards. So you could no longer carry NOLs back, but you could carry them forward forever. And the CARES Act allows a 5-year carryback of NOLs arising in tax year beginning after December 31st, 2017 and before January 1st, 2021. In addition, it suspends the 80% taxable income limitation for tax years beginning before January 1, 2021. So now if you have $100 taxable income, you can offset all of that, all $100 with an NOL. In order to claim a refund for a carryback, you'll have to file an amended return. And there's really the carryback has two benefits. One is the timing and getting that refund now as opposed to waiting for a subsequent period. And then also the rate differential, because the TCJA lowered corporate tax rates. So you could go back to a year which the tax rate was higher and get a increased benefit. So we've got an example that illustrates this. So in 2019, assume you've got an NOL of $100. Under the TCJA, you could carry that forward to 2020. And the NOL would offset $80 of taxable income. If you have $100 taxable income, that's that 80% limitation, which would result in tax savings of about $17, which is the 21% tax rate times the $80 NOL. And then you have that $20 NOL you would carry forward to a subsequent period, and you get another $4 when you use the remaining $20 on NOL. So that's a total of $21 in tax savings. The CARES Act would allow you to carry back that same $100 NOL from 2019 to 2014, and then the NOL is not subject to the 80% limitation, so you could offset $100 of taxable income in 2014, and then you get a refund of $35, which would be the tax rate in effect in 2014. So the carryback allows you, $14 more than the carry forward.
And $35 today beats the heck out of $17 next year and $4 after that.
That's right. That's right. And so now let's talk about the business interest expense limitation changes. So the TCJA it limited the business interest deduction to 30% of adjusted taxable income, which is ATI, and it disallowed the interest deduction the disallowed interest deduction can be carried forward indefinitely. So anything you don't use, you just can carry forward. The CARES Act for 2019 and 2020 increased the limitation from 30% to 50% of ATI, and taxpayers can elect to use their 2019 adjusted taxable income to determine the 50% limit in 2020. And this is really helpful because most people are going to have a much higher ATI in 2019, you would think, pre-pandemic, pre-financial crisis, than they will for 2020. So as an example, if a corporation has $100 ATI in 2019, and then in 2020, they've got $50 ATI and $50 of business interest expense, the corporation can elect to use that 2019 number of $100 ATI to calculate their business interest expense deduction in 2020, which would allow them to deduct all 50. If they'd use the 2020 $50 ATI, they'd only be able to deduct 25. Now there's a special rule for partnerships for their 2019 interest expense. Partnerships do not, yeah, perfect, thanks, Abbey. Partnerships do not get the 50% ATI limit for 2019. So partners, the business interest deduction limitation is generally calculated at the partnership level, and then partners are allocated their share of the business interest deduction and any excess business interest. And so instead of allowing partners the 50% ATI limit for 2019, Congress provided for a special rule for partnerships where any excess business interest expense deduction that they were allocated in 2019 but they couldn't take, they can deduct 50% of that in 2020 without any ATI limitation. The remaining 50% is still subject to the normal rules. And if it's for some reason not beneficial to use this special rule, a partner can elect out. And we've got an example of that on the next slide. So if a partnership had $100 of ATI in 2019 and $70 of business interest expense, the partner is of course subject in 2019 to the 30% limitation. So they had $30 of deductible business interest expense. And then the excess 40, they would allocate 20 to each of their two partners. And then each partner can automatically deduct 10 of that 2019 excess business interest expense in 2020. And the remaining 10 is then subject to the ATI rules and the limitations. Right, next we're going to touch on just briefly the alternative minimum tax credit. So the TCJA repealed the corporate alternative minimum tax, or AMT, and companies that had AMT credits, they were refundable over several years beginning in 2021. So they would be able to monetize them, but there would be a delay in monetizing them. The CARES Act allows corporations to use those AMT credits immediately, either as a refund or a credit to offset current year tax. So it increases the ability and the time period in which you can monetize those credits. All right, so excess business loss limitations apply to non-corporate taxpayers. And under the TCJA, it allowed deductions attributable to trade or business only up to the amount of income from that trade or business plus $250,000 if you were a single filer, or $500,000 for joint filers. The CARES Act lifts this limitation for tax years beginning in 2019, and 2020, which allows the deduction of excess business losses for those years. And the last specific provision we're talking about the CARES Act is the what's so-called retail glitch. So the TCJA, there was a technical drafting error that caused qualified improvement property, or QIP, which is improvements to an interior portion of a building that is non-residential real property, like retail property, to be depreciated over 39 years as opposed to the intended 20 years. As a result, this made QIP ineligible for bonus depreciation because bonus depreciation is only available for property with a depreciation recovery period of 20 years or less. The CARES Act fixes this so-called retail glitch, and it sets the depreciable life of qualified improvement property at 20 years. So now QIP qualifies for bonus depreciation. Bonus depreciation, of course, is great because it allows the taxpayer to immediately expense a large percentage of their basis, which right now is 100%. The change is permanent and retroactive, and it's effective for property placed in service starting in 2017. So you can file a refund and elect bonus depreciation for property, QIP property placed in service since 2017, 2018, or 2019. And now I'm going to turn it over for Abbey to talk about real free money, the money that you get from the federal government that was never yours, but is loaned to you, but may be forgiven in certain circumstances, that, as he'll explain.
Exactly. And Lee, back on both that bonus depreciation and also the NOLs, I think it is valuable to highlight that you can go in right now, file those amended returns and get money fairly quickly. Another way to get money back in your hands to help your business keep going.
That's right. And the same thing with the excess business losses. You can amend your returns, claim those losses, and get that cash.
Yeah. So the goal of the Paycheck Protection Program, or the PPP, was to keep workers employed and paid by lending up to $10 million to small businesses to pay payroll and operations for 8 weeks at low interest rates, and then forgive a big share of that loan. And really what we're trying to do with this and the other legislation is save the economy. But it's been a moving target ever since the CARES Act passed at the end of March. Because the CARES Act gave an outline of what Congress and the administration wanted to do, but they left it up to the SBA and the Treasury Department to fill in the gaps. And the SBA does this by posting interim final rules. Now, later, I'm going to tell you something I really want you to know. This is not it. There's nothing for you to gain by knowing that the SBA publishes interim final rules, but I can't unlearn that. Who the heck decided to call something interim final rules? Anyway, the PPP.
I think now, Abbey, none of us are going to be able to unlearn that.
Well, okay, so you have learned something. All right, so the PPP provides for fully guaranteed forgivable loans to small businesses. That's a double wow. Fully guaranteed meant bankers were lining up to participate, including all kinds of lenders who never wanted to mess with SBA loans before and their particular requirements. And you definitely got in a lot of the fintech, the PayPals of the world were also jumping in to loan this money. And forgivable, so that was guaranteed. And then the forgivable meant anyone whose business was affected by the pandemic really should apply. And as you may have seen in the news coverage, there was an initial $349 billion, and it ran out incredibly quickly, which shouldn't have surprised us. So Congress and the president appropriated more funds in late April. And SBA's authority to guarantee PPP loans expires on June 30th. So if you have not applied and you qualify and are still thinking about it, then you really should jump on it. So now the latest bill, the Paycheck Protection Program Flexibility Act of 2020, passed week before last. And that, again, gives some flexibility, as in the title. It gives businesses 24 weeks instead of 8 to spend the money and ask for forgiveness, which many needed. But again, it was not artfully drafted, so it raises many new questions. It lowers, one thing that was very valuable, it lowers the percent of forgivable debt that has to be spent on payroll from 75 to 60. So that meant more could be spent on certain non-payroll costs like rent or mortgage interest and utilities. Mortgage interest, the annual interest rate is 1%. It may be a little bit more on smaller loans. For loans made after June 5th, the maturity is 5 years. For loans made before June 5th, under the original program, the majority is 2 years, but borrowers and lenders can mutually agree to extend that time to up to 5 years. Now, lenders may not want to. I don't know how many bankers are comfortable carrying 1% loans on their books if they don't get forgiven for 5 years. So one of the questions it raises that we don't have the answer to yet is can borrowers and lenders agree to raise the interest rate as part of the deal to lengthen the term? And we're going to get guidance on a lot of things, and I imagine that'll be one of them. So loan forgiveness. The loan forgiveness period, the covered period, which is a term of art in the Act, is 24 weeks beginning on the date of disbursement, so the date that money comes out. If the loan was pre-June 5th, you can elect 8 weeks if that fits your situation. Now, if you apply for forgiveness, you don't have to make any payments of principal or interest before the SBA forgives all or part of it or says that it's not going to. And if you don't apply for forgiveness, then you must start paying it back 10 months after the forgiveness covered period. So if you got a loan today, 24 weeks from now is going to be early December. 10 months later is going to be October of 2021. that's a heck of a deal we're all making to each other. I mean, this is our money, right? So as I mentioned, to receive full forgiveness, a borrower must use at least 60% of the PPP loan for payroll costs. And now originally, the guidance said it was going to be 8 weeks of payroll. Now people are saying, is it more than that? Loans were going to be for 2.5 months of payroll. Forgiveness was going to be 8 weeks plus some of those other costs I talked about. It might be more. I don't think loan amounts are going to be raised, but they may make a bigger part forgivable. So we're waiting to see on that also. Now, I was going to walk you through the 11-page loan forgiveness application, but it has a lot of language like you see here. Enter the amount from line 3 of PPP Schedule A on line 5 of the loan forgiveness application form. And it occurred to me that many of you just graduated from homeschooling your kids for the last few months. So I'm going to give you a break on that part. But if you're like my wife and you think tax forms are fun, then you'll love the PPP loan forgiveness application. Okay, so free money, what's the catch? Well, what can you spend it on? Salaries and wages. And this does include paying yourself. So if you're an independent contractor or a sole proprietor, you could still get in the program. Sick leave, vacation, parental leave, those things are covered. Health benefits are covered. Rent or mortgage interest. Now, and it's not a catch here, but the rule is it has to be under a lease or a mortgage that was in effect before February 15th. We didn't want people running out all of a sudden making some kind of special rent deal that they could then grab a bunch of money that was going to be loaned to them and forgiven to pay rent to their brother-in-law or something like that. Utilities, I think, is fairly self-explanatory: electricity, gas, water, telephone, internet. Now, normally, forgiveness of debt is taxable income. If you've got a bona fide loan out there and the creditor forgives that, you work out a deal or whatever, then you're going to get a 1099, and that's going to be taxable income to you. But not in this case. As part of the original CARES Act, it specifically says the debts that are forgiven under this are not taxable income. Now, the other question is, if you pay expenses with PPP money that's forgiven, can you deduct those expenses? Right now, the answer is no, you can't. Several members of Congress want to change that. We, at one of our exciting tax meetings in the office, several of us were debating on whether or not it's appropriate, because, well, why can't I deduct my payroll? I always deduct my payroll. And then somebody else might say, well, you're not paying it with your own money, you're paying it with the government's money. But some influential members of Congress actually want it to be deductible. So we'll see if any more guidance comes on that. But right now, no, if you get the loan forgiven, those expenses are not deductible. Okay, I got to talk about audits with you. The Secretary of the Treasury came out fairly quickly to say that all loans in excess of $2 million are going to be audited. The SBA has added to that to say, in addition to other loans as appropriate. So we recommend documenting your actions now in case you get audited later. And here are some suggestions of things you would rather do now than when you've got some federal agent knocking on your door. So documenting in detail the needs of the business going forward, the use of the proceeds, what risk you had of having to lay off or terminate employees in the event you did not get a PPP loan. Again, showing that the proceeds were actually spent on the specified costs, payroll, rent, utilities, the things that qualify forgiveness. You want to document any efforts you made to rehire previously terminated or furloughed employees prior to June 30th and any refusals of such offers, because you're not held responsible if you tried to bring your people back and they got a better deal elsewhere for whatever reason didn't come back. And if you can gather any information about your industry, terminations, layoffs, other people in your line of business, that could be helpful as well. Here's a few more. Modeling productivity, demand for goods or services, historic data showing the decline following the onset of COVID-19 if possible. any evidence you would have about alternative sources of capital or really the lack thereof when this thing hit, and the terms that you would have had to face. I think we mentioned tracking proceeds. Here it says putting them in a separate account. I think that would vary depending on how big you are and what your situation is, but at least, again, tracking how you use the proceeds so we could show that they were used for the proper purposes. And of course, I couldn't have a slide without saying consult with your regular attorneys. There have already been indictments of a few people who tried to defraud the system, including at least one here in Texas. So definitely consult with us before you do that, so we can tell you it's a bad idea. I would say now is a particularly bad time to be in prison, but I think it's always a bad time to be in prison. There's also a Main Street lending program for small and medium-sized businesses. And
can I interrupt with a
Yeah,
question on
please.
the PPP loans?
Yeah, please.
Because I know one question we've gotten is whether the information about who took a PPP loan would be public or not.
Right. And for the last 20, 30 years, SBA loans are public, and there was a downloadable list where you could go and put in 75080 or whatever Richardson's zip code is and see who was getting loans, because we've got transparency in government. We want to see where government money is going. But up till now, some of them have been well publicized, but the SBA and Treasury have not released a list. And I'm not saying count on that. There still could be a public list, but up till now that has not been disclosed. So thanks for reminding me to point that out. So I was saying before we jump to the payroll credits and tax deferral, there's also a Main Street lending program, which has gotten some press for small and medium-sized businesses. And then there's a primary market corporate credit facility for large companies. These are full recourse loans, unlike PPP. These are not forgivable, unlike PPP, but something that certain companies would want to think about. So now I'm going to turn to payroll tax credits and deferral of, first I'll talk about deferral of payroll taxes. Again, another source of liquidity for you and another moving target. So as it shows on the slide, small businesses can defer paying the employer's share of payroll taxes that were due from March 27th of this year through the end of the year. And the deferral is half of that money will now be due at the end of next year, 12/31/21, and the other half won't be due until the end of 2022. So when I said moving target, originally the way it's laid out is you could choose to defer the payroll taxes or you could choose to put in for a PPP loan, but not both. Then guidance came out saying, well, you can apply to PPP and you can defer your taxes until you get forgiveness. Now it is defer anyway. Even if you've got a PPP loan, even if you apply for forgiveness and you get forgiveness, you still get this deferral of payroll taxes. And frankly, that may make the IRS's job a little bit easier than trying to figure out who was allowed to defer and who wasn't. So this is, as I mentioned, another source of liquidity. But as somebody who worked for the IRS for a long time, I'm telling you, do not confuse deferral with forgiveness. And we'll talk more about compliance in a minute. Now we've got the employee retention credit. This is also really a great source of funds for your business, but this is for employers who did not get a PPP loan, or you got one and repaid it by May 18th. This is the employee retention credit. It pays you up to $5,000 for each employee you have on the payroll. So this is for employers who had to fully or partially suspend operations due to orders from an appropriate governmental authority limiting commerce, travel, group meetings due to COVID-19, or even if you weren't ordered to suspend operations, you experienced a significant decline in gross receipts during a calendar quarter. Now, a significant decline in gross receipts begins with the first calendar quarter this year in which an employer's gross receipts are less than 50% of its gross receipts for that same calendar quarter in 2019. And now the significant decline is going to end with the first quarter after a quarter where those gross receipts get back up to greater than 80% of the comparable quarter from last year. we'll go over an example of this in just a sec, but it is a fully refundable tax credit for employers. That means it is refundable to you even if you don't owe tax this year. It is equal, as I mentioned, to 50% of the qualified wages that eligible employers pay their employees after March 12th through the end of this year. Now, the maximum amount of qualified wages taken into account with respect to each employee is $10,000. So that means a maximum credit of each employee of $5,000. And since Lee did an example, I thought I would do an example.
I love examples. Thank you. If this is for me, I love it.
Okay. So let's say you've got 5 employees. They each make $1,000 a week. Very simple. Last year, we were very steady. We had gross receipts of $100,000 a quarter. And then you can see on the slide that first quarter of this year, we were doing pretty good until the COVID hit. Second quarter, we really got the brunt of it, coming back a little bit in third, a little bit back in the fourth quarter. So when do we start counting in terms of when have we experienced a significant decline in gross receipts? And the answer to that is going to be the second quarter. If you compare 100,000 a quarter last year, half of that is 50. Second quarter of this year, we only took in 40,000 in gross receipts. We're under 50%. We are now eligible to get this employee retention credit beginning second quarter. When does that end? Well, it's when does it go over 80%? That is not till the fourth quarter. We can keep claiming the credit in the fourth quarter. At the end of the fourth quarter is when we're done experiencing a significant decline, and the credit runs out at the end of this year anyway. So we can claim the credit for wages we've paid second quarter through the end of the year. Now, we can't claim it for $1,000 a week for these employees for the rest of the year, whatever that would be, $30,000, $40,000 each. Remember, our limit is $10,000 each. We've got 5 employees. That's $50,000. Our credit is half of that. That's $25,000 coming back to your business that you can put back in the business. So that is a very valuable thing. If you're not in the PPP loan program, this is a way to get money in your hands right away. Jumping, we talked about deferral of the payroll taxes. We talked about the employee retention credit. Just real quickly, there's some credits if you had to pay people for sick leave, family leave this year. Another source of liquidity from the CARES Act is borrowing from your IRA or other retirement plans. And I won't get into the details, but there are provisions that let you borrow up to $100,000. And number one, not pay the 10% early withdrawal penalty. And number two, pay the taxes on it or pay it back to the retirement plan over 3 years. Normally, you would pay taxes this same year that you took it out. Here, we're going to spread that over 3 years or pay it back over 3 years. Okay, let's take a few minutes to talk about the IRS. So what has the IRS been doing and not doing the last few months? Well, like most of us, they've been working from home, and that varied. Some of the IRS employees were used to working remotely, appeals officers especially. This is something they've been doing for a long time, all the way to the other extreme. You have some jobs that they really can't do from home. Face it, we're not mailing our checks. Those of us who are still paying with paper checks to their houses, those are piling up at the service centers. And so the first thing to do was try to get some of those people back to work. The IRS did just send out over $250 billion over the last couple of months. Their main obligations have been issuing refunds. This is filing season, extended filing season, and stimulus payments, which we hope help the economy. But like it or not, we need the IRS to handle that. So that's been their main focus. So number one, July 15th is 4 weeks away. You need to file your 1040 or get an extension. And even if you get an extension to file, that is not an extension to pay. So you need to have your 2019 liability paid by July 15th. And we also need to get our 2020 estimated tax for the first 2 quarters of 2020, which would have normally been due April 15th, and June 15th in by July 15th. So that's your homework from today is July 15th, take care of your 2019 liability, take care of your estimated for the first 2 quarters of 2020. And it says here what you have to do. This is where I'll make a quick pitch for paying estimated taxes. It is a good way to stay out of trouble. When I worked for the IRS, I would talk to our new attorneys. I told them everybody that works for us gets their tax return looked at every year. It doesn't mean a full audit. It does mean we get looked at. And really the best way to get in trouble, the best way to get fired is to mess up on your taxes if you're working for the IRS. You may not have that exact concern, but you still don't want to mess up on your taxes. And estimated tax is such a great way to stay out of trouble because if you take last year's taxes and pay it quarterly, a fourth of what you owed last year, or maybe a little bit more if you're in a higher tax bracket, then that gives you a safe harbor and it will prevent you from getting assessed penalties if this year your income is way out of whack compared to last year, but you at least made estimated payments timely. So please do that. Lee, can we talk about audits and appeals and what the IRS is doing there?
Yeah, so let's start with audits. So with audits, I think a lot of the LB&I taxpayers, so those are the large business and international taxpayers, their audits, their revenue agents are in close contact with the companies, and their audits have probably proceeded. Certainly our clients, they seem to have proceeded. There seems to be more IDRs issued or requests for information recently, but I don't think they stopped auditing the LB&I taxpayers. Now, for individuals or small businesses, they've probably stayed, maybe have been working, but not interacting with taxpayers, probably giving taxpayers a bit of a break. Wouldn't you think, Abbey? During the crisis, a little bit of space.
Definitely.
And certainly probably not requesting any in-person meetings from, I think, no matter what kind of taxpayer you are. For appeals, were you going to say something?
What's that?
Oh, I thought you were about to say something, so I was going to. For appeals, as Abbey said, appeals officers have been working remotely for years. And so this is just, business as usual for them. I know Abbey's had a number of appeals conferences telephonically, and over the years, I think we all have, and those have worked well. Appeals officers, sometimes I feel like I really need to convince them to see me in person to begin with. So they might prefer this because they have an easy excuse to avoid that in-person meeting, but they've been able to effectively work remotely and through telephone conferences for a while.
Yeah, and that has been really helpful for some of our clients that we've been able to do the appeals conferences because people at that stage of the game do want to get things resolved and keep moving. I'll touch on collection. The revenue officers, those are the IRS personnel who have the task of actually going out collecting money that has been assessed. They have basically been shut down with a few exceptions. I think they're going to be chomping at the bit come July 15th to get what's out there, especially in the more egregious cases. So on this slide, I say, what else do you have to do? And collection officers reminds me of keep up with payroll tax. We talked about how your half is deferred, but the employee's share and what you withhold from employees for their income tax is not deferred. And as a matter of fact, the IRS will tell you it is not your money. You're holding it in trust for the employees. And the same way I told my IRS employees that the best way for them to get in trouble was their personal tax. Well, the best way for any business to get in trouble is payroll tax. That's something that the IRS is always in tune to. It is always a priority. Because again, it's not really your money. It's money that you're holding in trust for your employees, and it needs to go to the government so that it funds Social Security and also funds their refunds when they file their tax returns. And the other thing, the IRS views this as a real competitive disadvantage. If you've got mom and pop on one side of the street who are not paying their payroll tax and have all that money in their bank account for operations, and mom and pop on the other side of the street who are paying their payroll tax, you can imagine that that's quite a difference in how they can run their businesses. And so that's an area where, like I said, the IRS has always made it a priority. I got a call from a revenue officer the other day about a client, because this is something they're not going to wait for July 15th on if they think somebody's pyramided payroll taxes. So we did get that straightened out, and I would encourage you to do that. So in terms of, as Lee was saying, when they do come back, it's going to be a slow ramp up. They need to open literally millions of pieces of mail. I think one article said they've got 10 million pieces of mail waiting for them. Figure out what the priorities are. I guess if there's checks in there, get those opened first, and then attack their priorities. I mentioned pyramiding, which is what you call it when employers rack up multiple quarters of not paying payroll taxes. Tax shelters are always going to be a priority for the IRS. A couple of things that have gotten some publicity over the last year or two are syndicated conservation easements and micro-captive insurance. And again, these are things that can be perfectly legitimate. They're provided for in the tax code. And like almost anything else, the fraud of the PPP. There are good ways to do things. There are bad ways to do things. And the government's going to go after the bad ways.
The only other enforcement effort I would add to that list, Abbey, are the non-filers.
Right.
They have ramped up enforcement against non-filers too.
Right. And that was one of probably the biggest surprise when I went to work for the government was how many people just don't file. And the IRS is going to make a push. And again, the same reason that Jesse James robbed banks, that's where the money is. Their push is going to be with high income non-filers and high wealth non-filers, which there's a Venn diagram there. They're not always the same people. So we've been talking quite a bit. Want to hear what questions you have. And somehow I've lost the chat bar, but Lee, I hope you can see it.
I've got it. So if
Okay.
people chat their questions, I can read them aloud.
Hi, this is Paul. I'll be here helping you out. I think we've got not any questions at this point. I do want to go back to while we're waiting on some questions asked. Did you see one?
No, please go ahead.
I read something the other day that part of the reimbursements are part of the I guess it's free money to a degree, but reimbursements that help small to mid-sized companies pay for some of their employees' coronavirus medical expenses. Has there been any rulings or policies on that? I think it's mostly related to helping the cost of that. But have you heard anything about that? Yeah, and there are definitely some provisions in there, including not just the cost of the treatment, but I think, as I mentioned, if somebody is out on sick leave, either for themselves or you're giving family leave related to COVID, there is relief for that. And if anybody wants to contact us, we can get into the details of both of those. But that was something that in the original CARES Act that I think there was bipartisan support that we definitely have to have something in there for that. So are there tax implications for that, obviously? Or is that free money, as you were talking about?
That credit really is it's a fully refundable credit when your employee has to take sick leave for the coronavirus. So it is I had to look into this actually with unfortunately somebody whose husband contracted the coronavirus, and it is a fully refundable credit. It's based on what their wages or their hours were over the previous 6 months, and it's free money. So that's good news for the employer, and I think the right result. I totally agree.
So what are you seeing from your clients right now? What are the biggest issues? Because this is a really complex set of information and guidelines that are in the process of being written and changed every day, it seems like. What are your clients telling you are the biggest challenges they have with all of this? Or what do you see as the biggest challenges?
Well, I'll jump in and then Lee, you can go next if you got anything. On the PPP loans, there was just a lot of frustration for a lot of reasons. At the beginning, it was so hard the bankers and the CPAs were working around the clock to figure out the application, and then the money dried up incredibly quickly. And some people were told to wait. I think a lot of independent contractors were told to kind of get in line behind employers, and they need the money just as bad, if not worse, than any other employer. So you had some frustration there, and then the guidance, like I said, has changed a few times in terms of what qualifies, what doesn't qualify, first for the loan and then for the forgiveness. So some frustration there. We've been trying to get out client alerts as things happen, and we also have a blog you're welcome to look at. But I think that's the main thing.
So this is Mallory. We did have a question come in, and so I think what they're wanting to know is, we understand now to achieve the full PPP loan forgiveness, the recipient of a PPP loan must use the proceeds on allowed uses such as payroll during the 24 weeks after receipt rather than previously described during the 8 weeks following the receipt of the loan. Is that correct?
Yes. So the short answer is yes. The long answer is there's a couple of little details that were, maybe more than a couple, that we're waiting to hear back on. For example, if the amount that an independent contractor could have forgiven is at the most would be 8 weeks of $100,000 salary prorated. If the independent contractor paid himself more than $100,000 last year, the cap was $100,000, and if you take 8 divided by 52 times 100, you end up with $15,000 and change. And so now we've got somebody saying, well, if I pay myself over 24 weeks, all of a sudden, what's 24 over 52? 40,000 or something. Is that amount going to be forgiven? And my answer right now is just, I don't think so. But we haven't seen that come out precisely. So there's a lot of things like that. But they did extend the covered period to 24 weeks. So I think in terms of the payroll that you put in the application, using that is fine, and you want that to cover at least 60% of your forgiveness, and your rent agreement you already had. Now you can be able to pay that rent over a much longer period. Then that'll be able to get you, we hope, closer to 100% forgiveness of the loan as opposed to where you may have been otherwise.
Okay. Let me know if that answers your question. If not, feel free to also raise your hand, guys, and I can unmute you and you can ask your question specifically. There is another one. I sent a check on April 13th for 2019 taxes with application for automatic extension. Cashed on April 17th. So someone was present at the IRS to open the mail and process the checks. That was a statement from another attendee.
Right. And I think we're glad to hear that, because that's one less thing for the IRS, for that person. We're happy that they've already got their check cashed, so they should be getting credit for it. And I know the IRS was working on how to get the mail open while everybody was staying home. And again, so that one happened very quickly, and glad to hear that.
Because we have heard some problems with, people that, the IRS opening mail to the extent they can get to it, and then they need to get it to the person who's working on this, right? So whether it's somebody in chief counsel looking at a ruling request, or whether it's an auditor, and so then it has to be scanned in and sent, and there's just that many added steps can cause something to get lost in the shuffle. So I think it's welcome news that your check was cashed so promptly, and that you were not lost in the shuffle.
Yeah, no, we had one of our California clients who filed 3 amended tax returns at the end of last year. And then their accountant has been checking to see where are these in the process. And the first thing I found out was that the 3 returns were in 3 different places. And I was like, well, that's not good. But then just the other day, they found out they're now associated with the same person. So we're hoping that gets back in order quickly.
Yeah. And
So are you expecting a lot of problems or challenges, maybe the better term, as the IRS employees begin to get back to work? Some of them are still not in the office, I understand. That's going to be a real problem come July 15th when individual tax returns are due, not to mention the tax returns for the businesses that come later this year, right?
well, I will say, I mean, Avi, I don't know about your experience, but I've had a number of clients file early to get their refund or file based on these and have gotten their refund already. So automatic deposits are still happening, and the IRS, despite the mountains of mail that we keep reading about, seems to be functioning relatively well, with the exception of some anecdotes that we hear about of things getting lost or misplaced.
Yeah, I think the good news is maybe 80% or more of individual tax returns are filed electronically, and so those were able to get processed, and a lot of refunds got issued by June 1st, which is wonderful. On the other hand, anything having to do with paper, I think is going to be a slow climb. I think you could expect, if you are under audit, revenue agents will probably be asking you to extend the time that can go on while they dig through things. So we'll see. But it's, last year the government had a 5-week shutdown, and the IRS took a long time to sort out everything after that. This one has gone on much longer than that. And in addition, you're going to have some other concerns with not everybody can come back to work. So it will be interesting. I think there'll be challenges on all sides. I think they're going to be asking us for patience, and in some cases, we're going to be asking them for patience. Depending on the situation of our clients.
And Avi, I saw that, I think this is the tax press reporting, that some IRS employees at the Austin Service Center had tested positive for COVID-19. And I don't know anything about the setup there. Are people able to work safely and socially distance in this business? Or are they going to have problems bringing people back?
Yeah, and I'm not sure about that particular story exactly, but as you can imagine, these campus operations, you do have a lot of people working in close quarters, and I think just like every other business, they're going to have to. I'm sure they're putting in different equipment, guards, and so forth between people to try to keep people a little bit safer. And then I've also heard about an attorney with counsel that got COVID, and again, IRS has tens of thousands of employees, and they're going to hit just like everybody else, and so that's going to be a concern. Now, the one thing that they do have a lot of plans in place, unfortunately, because of anthrax and other things that have happened in the past, where they could seal off parts of these campuses and keep other parts working, and they could also redirect work to different parts of the country. Now, this has been unlike any of the disasters in the past, hurricanes and fires and so forth, and it is a disaster throughout the country where every office was closed, and so that's what's going to take them longer to come back from.
Okay, any questions out there that anybody may have? It's getting close to 1 o'clock. If not, I want to take this opportunity to thank Abbey and Lee for being with us during the lunch hour. It was a great presentation, lots of information for us to go through, and I'm sure to keep you and your team occupied in the coming months. So thank you so much for taking the time to be with us, and we look forward to perhaps doing this again sometime for an update.
Oh, you bet. That would be fun, and we enjoyed it, and we'd love to hear from anybody, any feedback they have on the program, questions. Certainly call or email Lee or me anytime, and we'll be happy to talk to you.
Great, thanks so much. I do want to mention as we close here that there are several programs that the Richardson Chamber is having in the next couple of weeks as we hit the July 4th holiday. I'm not going to go through them at the present time. Just would encourage you to check the full listing and registration and future programs at the Chamber website, richardsonchamber.com. Otherwise, I think we are adjourned. Thanks everyone for being here. You all have a great day, and we will talk soon. Thank you so much.
Take care.